Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's November 13th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Do you guys know how bearish I've been on China? I know you follow the news. The U.S. and China have been in a so-called trade war for close to 2 years now. We've seen millions of crazy headlines about how this trade war is going to destroy our economy. It's going to lead to war, since protectionism has led to wars in the past. It's going to create a depression where millions of Americans are going to lose jobs, how sectors like technology, consumer goods, which are basically heavily dependent on manufacturing, and from China, they're going to get crushed. How China is going to become much stronger than the U.S. because of this trade war. And again, it's not millions, it's tens of millions of headlines. I mean, just put trade war will kill America, right? Just put that in Google. Well, it will destroy America. And for me, it came up with 16 million results, right? All these stories, right? All this crazy stuff, the ups and downs, the markets and back and forth, all this stuff, right? And what it turned out to be? Complete bullshit. Complete bullshit, which I told you it would be. For 2 years, I've been telling you that. And by bullshit, I mean the trade war did not hurt America. It did not hurt our economy. It did not lead to fewer jobs or layoffs, right? We have record low unemployment. Certainly did not result in China getting the best of us, since their economic numbers are pretty much horrible. I'll give you a quick rundown. GDP near a 30-year low. Industrial output at its lowest levels in over 10 years. China's exports to the U.S. are down 16%, guys. That's a monster number. Monster number. China comes out with their beige book, just like we have our beige book, where it's like a survey of businesses, and it's 3,300 businesses in China that they survey. And the latest reading was horrible, showing that revenue, profits, output, sales volumes, job growth is going to slow from last quarter, along with both domestic and international export orders. So you're looking at all these numbers. I mean, the icing on the cake is look at the debt levels in China. I mean, risen tremendously throughout this. Now, I'm not saying it's to pat myself in the back here, right? You guys know I'm probably the most humble guy in this entire industry, right? I cover my losers and everything. But I was adamant telling you to ignore the trade war fears. Ignore the headlines. And most people commenting, writing about this stuff, they have little understanding of the subject. They want to try to scare the hell out of you. It's always nice to get Trump in a headline because it's going to get more page views because they're like the New York Yankees. If the New York Yankees or Boston make it or Dallas Cowboys, people watch those events if they make it into the Super Bowl or the World Series because you either love the Yankees or you hate the Yankees. You either want to watch it because you hate them, you want them to lose, or you're a fan, you want them to win. Either way, it gets the highest ratings, right? So that's why people love Trump in the headline, which this is all about Trump because he's basically taking on China by himself. He's not going through Congress. This is something that he has the ability to attack them just from himself. And that's what he's doing, right? He's taking on China. And when I look at it, right, the U.S. economy, it's the greatest in the world. It has the biggest spenders in the world by a mile. And China is a manufacturing giant. So for me, you could look at all the numbers, and numbers are evident how China's market crashes much more than ours when we had, tensions, and it goes up higher when we didn't have tensions because it fell so low. But you could see that it influences China much, much more than it influenced us, which forget about the stats, which people don't like looking at, but just ask yourself a simple question, right? Let's use a little common sense here. Which one do you think holds more power? Is it the country with consumers that spend boatloads of money on new products, no matter who makes them, right? They just love to spend money, or the country that manufacture these products? Because when I look at China manufacturing, it can't sell all those products they're manufacturing to anyone. They're selling them to the U.S. with the biggest buyers. But if you're the U.S., you could buy these products anywhere. And of course, listen, the U.S., we're going to have to pay a slightly higher price, but countries are lined up around the block to produce for us. Not getting it from China. Let's get it from someplace else. We'll still get them at a higher price. Yes, it'll hurt margins a little bit. I get it. A lot of that will be passed off to the consumer, whatever. You could say economic, whatever it is. But our impact is going to be much less compared to China, where they're sitting on all this inventory. And what are you going to do? These inventory levels inflating. You get stuck with a lot of these products. Just as common sense. And I just laugh when people say China's killing us in a trade war. China has to do a deal with us. They have to. They have to. I mean, look at the stats that I just read off. It's a disaster there. So I've been adamant about avoiding China for a while. And even with the positive trade talks, right, where phase one of the trade deals expect to be signed, whatever, coming weeks, coming months, early January. But you're looking at the China market, Hank say it's down close to 20% since the trade war started. This is around February 2018. While the U.S. stock market is up about 17%, including dividends over the same time frame. That's pretty amazing when you think about it. I mean, imagine your entire nest egg, your retirement, all your money was in the S&P 500, just say, and you fell into a coma from February 2018 until now, right? You just woke up and you looked at your portfolio, went online. You'd be like, wow, this is cool. I'm doing just fine. I mean, go back to sleep for another 2 years, whatever you want to do, but you'd wake up and be like, wow, this is really cool. Now, my point is, if you didn't watch the financial media every day, if you didn't read all the crazy headlines put out by these organizations, if you shut off all your social media accounts, which, man, the world would be a better place if people did this, you'd be up a solid 17% over those 2 years. Your portfolio would be fine. And most important, you'd have zero stress. Zero stress, since you're not watching the news. You're not watching these crazy headlines. You're not, the crazies on social media and the bots and the just, man, social media is just so disgusting now. The anger and how people attack, it's just, and I understand the trolling and fine, but man, it is crazy. It's crazy, social media right now. It's insane. You'd have zero stress if you just shut it off. All this trade, or think about all the stories, the top stories written in the Wall Street Journal, Washington Post, all the financial media, anywhere you look, CNBC, having people on. This is crazy. This is going to hurt us. This is going to put us into recession. We're at all-time highs, right? So ignore it. There's some things that you should ignore. This is one of the things that you should ignore. If you listen to me, you'd be right. Again, I'm not patting myself on the back. There's a point where I'm going here. Because I've been bearish on China for the past 2 years. But did you see the numbers from Singles Day? Is that a Monday? So Singles Day is an annual online sales event. It happens once a year in China. Sort of like an anti-Valentine's Day. That's how they describe it. It's an anti-Valentine's Day holiday, which celebrates people who are not in relationships. Anyway, you could buy, whether you're in a relationship or not, you could buy whatever you want. But it's held on November 11th every year. And this day was chosen since it's, November 11th. 1111. That singles indicates Singles Day. So they say. So it's like a Black Friday. Actually, not really a Black Friday. It's more like a Cyber Monday because it's an online holiday. This idea originated in 1993, but it wasn't deemed a holiday where, it was a massive online sales event until 2013. And in 2013, sales topped a whopping $5.3 billion just on that day. $5.3 billion on that day. In 2014, sales were $9.3 billion, again, in one day. Okay? So $5.3 billion, 2013, 2014 was $9.3 billion. This year, Singles Day generated over $12 billion in the first hour. In the first hour. Close to $40 billion in sales for the day. I mean, 38.5 billion. It's so, again, trying to figure it out. They're still trying to, but it's close to $40 billion in one day. You put that in perspective. Cyber Monday last year, they generated about $8 billion in sales. But let's even go further, okay? Because I did a little research here. The $40 billion is close to $40 billion in one day. That's more revenue than companies like Coca-Cola, McDonald's, Goldman Sachs, Starbucks, Philip Morris, told you did research on this, Raytheon, Visa, Nike, Oracle, Honeywell. That's more money than what those companies make an entire year. An entire year. That's how crazy that number is. And China does a great job promoting this, not just domestically, but internationally. I mean, you had for Kim Kardashian doing live streaming about new fragrances being available for sale on Tmall, which is a China online site. I know people hate Kim Kardashian. I wrote an interesting report on that because we recommended a stock in one of our newsletters that related to what they do. But, you know, these are the biggest idiots in the world, and their franchise is worth their family's worth $1.7 billion. I wish I was an idiot like that. So they're very, very smart. They've got into cosmetics. Kylie Jenner is now a billionaire. You look at Kim Kardashian, where she's one of the biggest influences on social media, biggest followings. She has a $350 million business by herself just with cosmetics. I mean, they're very smart. They're business. You could call them what you want, call whatever, but they understand business and they understand how to make money. I mean, it's just evident. Whatever. I don't care if you hate them or not, but China's great by signing them. They know what they're doing. Taylor Swift performed. Taylor Swift has probably the most, if I had to guess, the most Twitter followers out of anyone in the world, or pretty close, probably top 5. If you're looking at retail, U.S. retailers, over 25% of them joined in on this. And we're talking about Apple, Target, Macy's, Costco, all these companies getting involved. They should. Almost every clothing company, clothing brand has gotten involved too from the U.S. And they're posting deals on sites like JD.com and Alibaba, which are two of the biggest online retail sites in China. But this year, there are more than 200,000 brands. Not products, brands that participated. 1 million new products being offered at discounts. Not 1 million products, 1 million new products. And over 500 million users were buying these products, which is about 100 million more compared to last year. Now, what does this mean? Because for me, I'm always telling you, like, people have a thesis and they get emotions involved. Like, people believe that the debt markets are going to destroy us. And no matter what, they don't care. They don't look at interest rates, even though everybody's paying their bills on time. Interest rates are low. That's all you should care about with debt. And we're perfectly fine right now. We'll know when that shitstorm happens. We'll see it in credit default market. We'll see it in the bond market. Right now, everything's safe. But it doesn't matter. You have the diehards, the perma whatevers that are just going to say, well, the debt, you got to buy gold. They'll never change their mind. For me, what I always try to tell you is you have to be willing to change your mind if the facts change. There's no ego. Your money's not looking at your ego. They don't care who you are. Stocks don't care who you are. There's no personality in them, nothing. You got to do what's right for yourself. You got to understand the markets. And if your thesis is, wow, I hate something, and the reasons why you hate it change, your thesis needs to change. Don't be one of those people that are stubborn. I know if you're a guy and our demographic is probably a 60-year-old man, and I can tell you, I'm 47 and I try not to be like it, but I'm sure I'm going to be like it. But we become stubborn. We become just set in our ways and refuse to change, which is very, very bad. You got to be listen, it's not a personal thing. It's not an agenda. It's not getting your emotions involved to prove somebody else wrong. If the facts change. But for me, when I look at this data, $40 billion, it's a sign of the growing middle class in China, which everybody knew was growing. But not everyone knew that China's culture, I mean, this is a savings culture, right? People save, but the middle class is growing, and these people love to spend money on discretionary stuff. Love it. Again, it's a changing of the times as the next generation of spenders is coming into play. You're looking at these numbers and how big it is. And with China, I mean, the middle class is just getting bigger and bigger. But it highlights the massive growth in online shopping in China, which, you know, is e-commerce. Where in the U.S., e-commerce accounts for 11% of spending. And in China, it's close to 20%. But China's middle class is bigger than the entire population of the U.S. It's more than 400 million strong and growing. So when I see numbers like this, again, I've been bearish on China. Even though the trade war is nonsense, I know it's subsiding, and you know, a ton of U.S. companies have already moved the manufacturer supply chains out of China, right? It's just too difficult for them to deal with the uncertainty. Or how many ups and downs have we seen over the past 2 years between China and the U.S. and this trade dispute? Oh, things are good. Things aren't good. Oh, we're removing tariffs. We're not removing tariffs. We're increasing. It's up, down, up, down, up, down, and it's crazy. And for a company's point of view, they have to listen. If those increase in tariffs could mean the difference in a 10 to 15% disruption in their supply chain. So let's move someplace else. Of course, it's going to be a little bit more expensive, but at least we have transparency for our investors, because otherwise, every quarter we have no idea what's going to go on. It's all based on what Trump wants to tweet that day. Where you look at 40 billion in online sales, again, it's around 30, pretty close to 39 billion in one day. What does this mean? Well, I talked about sentiment last week in my educational segment. A lot of positive feedback from it. What I didn't mention is how important consumer sentiment is and how important that consumer sentiment is to economic growth. And we saw this in 2008 and 2009 when most Americans stopped spending. They stopped spending. They were scared. They were nervous. They wanted to take money out of banks since they no longer trusted the system. And what happened? It resulted in one of the worst collapses since the Depression in the late 20s, went into the 30s. That's why the government, what did they do? The government did everything in its power to incentivize spending. Putting money into the banking system, providing discounts, providing subsidies to anyone who's looking to buy a home or a car during that period. You got a discount. You got a check in the mail for a couple $1,000s. I think it was up to $8,000 if you bought a new home, if you bought a home. First-time home buyer. Here's an $8,000. This is what they did to spur because the consumer sentiment is so important when it comes to the economy. If people are happy, like they are now, see the stock market going well, they spend money like crazy. And that's a huge indicator. It's a huge indicator. So China, it's been a complete shit show, right? Not just because of the U.S. trade war tensions, but, you have the Hong Kong protests. Now that trade talks are more positive, they can figure out Hong Kong, which would be a great thing. This is an economy that can quickly turn around because sentiment is going to boom. This is what we saw from Singles Day, where Chinese consumers have a hell of a lot of money to spend. And man, they really, really like to spend. But these numbers blew me away. 38.5 billion in sales in one day. The estimates were around from 30 to 32 billion that I saw, but this is just incredible. And to me, it's a game-changing event. It highlights why China needs to do a deal with the U.S. where, hey, stop stealing our intellectual property. It seems pretty simple. Maybe it's not. It's a culture. Make trade a little fair where you're buying a little more stuff from us. This way, we lower the trade deficit. Because if China gets its act together, meaning if they start reporting real numbers, if they work with their trade partners, if they're more transparent, if they allow foreign investments, China's going to be the largest economy in the world. It's going to surpass the U.S. easily in less than 10 years. I mean, our economy in terms of GDP, listen to these numbers really quick. Our economy, U.S. economy, is $21.5 trillion. China's $14.2 trillion. Seems like a big gap. But when you go to third, hey, it's a major drop-off. You have Japan there at $5 trillion. Then you have Germany at 4, the UK's at 3. So it's really the US and China here that are 3-4 times the size of every other market. But you can see why trade and this getting along with the US is really important to China. But China becoming the largest economy in the world, it's inevitable. It's going to happen. It's just up to them on whether they want this to happen over the next 10 years or the next 30. But man, close to 40 billion in sales in one day. In one day. I mean, that's insane. That's a hell of a lot of money for people to spend on discretionary stuff. And to me, that's a game changer. It shows the middle class, hey, they're big spenders, not savers. And spending, from an economic point of view, is always much better for your economy than saving. Regardless of what you think. Yes, it's smart to save money. But the more you spend, that's how you drive economic growth. And that's clearly the case if they could figure out their problems. Where this kind of buying power, and this, it's supposed to be a market of savers, man, 40 billion in a day is a pretty big number. And yes, I'm becoming more optimistic on China, especially now that trade tensions aren't easing. Hong Kong's a big deal. Hopefully they can figure that out, but it's going to create a pretty big buying opportunity. And it's something that I'm looking at and getting a little bit more positive on. Again, guys, the lesson here is not that I want to give you a lesson in my opening, but be willing to change with the times. If the facts change. That number blew me away. To me, that's a game changer. It's definitely a game changer. Now, a great interview set up for you today. The guest, I think I only interviewed one time on this podcast about 4 or 5 months ago. He's a great analyst. Always shares some amazing ideas with me, and he did last time he was on the podcast, which is why I got some really good feedback from you last time he was on. His name is Chris Wood. So Chris is a 15-year market vet, specializes in technology, writes a Project 5X newsletter for RiskHedge, has a great track record. For me, I love talking to him because we have a lot in common. Always looking for under-the-radar small cap ideas, disruptors for our subscribers. Chris is a brilliant analyst, great guy. He's going to share his thoughts on the tech sector, which dominates the world. I mean, large cap tech, and most of you, I think, you know this, but the top 5 companies in the world are technology companies based on market cap. It wasn't always like that. Oil companies, telecom companies, banks, whatever. Now it's technology. So he's going to talk about, can this momentum continue? Are they going to get broken up? There's a lot more risk now, especially on the political front. Chris is going to tell us, share his thoughts on that. Also, he's going to share not one, but 2 of his favorite small cap ideas with us, which I'm sure most of you never heard of these ideas. They're new, they're under the radar. The companies that you're not going to find in financial media, financial blogs are really 2 good companies I think are going to be disruptors. Small cap companies, one has a $45 million market cap. The other one I think has less than a $200 million market cap. Again, 2 great names you're going to hear about. It's a great interview coming up. And in my educational segment, I'm going to break down how to be a contrarian investor. And I know that sounds incredibly boring, but believe me, it's going to be one of the most entertaining segments because so many people that I talk to and so many emails I get, they really, truly believe they're contrarians and they're not even close. They're not even close. You're going to be surprised to know that, hey, what you're doing right now, you think you're contrarian, it's not contrarian. It's actually the opposite. You're on the side that everyone else is on. But understand this concept, how to be a true contrarian, it's going to help you generate huge returns in your portfolio. I'm going to show you how to do that. There's a quick tease here. Because in this segment, I'm going to talk about at least 10 different stocks, probably more like 15 to 17 different stocks in this segment that could be huge buying opportunities. So guys, be sure to get your pen and paper ready. And it's going to be an awesome segment. But first, let's get to my interview with top tech analyst, Chris Wood. Chris Wood, thanks so much for joining us again on Wall Street Unplugged.
Frank, thanks for having me.
Well, so I love having you on, right? Because you follow technology, disruptors, and tech has been the best performing sector, it seems like forever, at least over the past 5 years, you could say, since credit crisis, where it's like a changing of the guard, right? I mean, you've been following this market for a long time where you had oil companies, some of the biggest companies, the telecom companies. Now, the top 5 are largest market cap companies in America: Apple, Amazon, Microsoft, Google, Facebook. Can this continue? Are these companies going to continue to grow? We have a lot of risk out there in terms of regulation, political risk, trying to break these guys up, which will probably make them even stronger, which usually happens when you break them up. But I wanted to get your take because these companies continue to do well, even though you have doubts with so many of them. And do you think this trend is going to continue with technology?
Yeah, that's interesting. I mean, it's crazy, right? We've got Microsoft and Apple are both above $1 trillion market cap now. Didn't see that coming, 10 years ago maybe. But yeah, honestly, I think it can continue. I don't think the government should be in the business of breaking companies apart. I think we're going to see that a little bit in the going forward. But at the same time, these companies are transforming themselves in a lot of different ways, right? Like Microsoft, now the most valuable company in the world again. Actually, I think second to Apple, but back in the day, they were pure software operating system. Then they made some bad moves into hardware that didn't pay off so well. And now, they've changed their strategy again, and they've gone all in on AI and cloud computing, and that's paying off for them big time. So, I mean, I think as long as they, can stay nimble and, continue to innovate, then yeah, things can continue going forward. We can see lots of growth. I mean, we're not going to see, I don't think we'll see a $2 trillion company anytime soon, but I mean, Google's continuing to innovate too. It's interesting though, because I mean, it stinks for retail investors in some way because, you have a cool opportunity like artificial intelligence, and there are these like great startups that doing all kinds of cool stuff, but then, before they go public, Google, IBM, Facebook, Amazon, Netflix, scoop them up. So it's great for those companies, and it's great for the Googles of the world and everything. But yeah, it's not so great for retail investors. I mean, now we've got half as many publicly traded stocks today as we did 20 years ago. And that's another reason why, I think that we can see things continue to grow too, because, where else is the money going to go, right? So yeah, overall, I think this trend in tech can continue. It's kind of creepy sometimes about how much the information some of these companies have about you, but apparently nobody really cares. Barring some really, really big, regulation type issues, I see these things continuing to go forward. Yeah.
And it's a good segue into my next question, because what you specialize in is you find disruptors within technology space and different areas, which is not that easy to do in this area, right? Other areas you could find something in biotech and invest early, where you're not going to see Pfizer take these guys over until they have phase 1 test results that look pretty good, and phase 2, where you can invest in these companies early on. When now, Uber's a great company. Yes, it's down tremendously, and it shouldn't have been trading at a $70 billion valuation, but it's still a $45 billion valuation. And it would be nice if investors could invest in this thing at a $1 billion valuation, $2 billion valuation. But all these companies, it's either like the AI-focused ones that have the best technology getting bought in the private market, or these guys are like, hey, we're going to do it on our own, and they get investments from these big guys, but it's all been done in a private market. And the time it hits the retail market, we're kind of like the suckers, right? This is where we dump everything on you, which, WeWork was almost, they were actually going to sell that to us, right? Which is amazing. But you see all these things coming out of crazy valuations where you can't buy them early stage in their growth. So how do you find the disruptors in this industry?
Yeah, I'm looking for, like you said, I'm basically looking for the next Netflix, Amazon, Google type disruptors before they made a big splash, and before everyone else has heard the story. I call my initial screen to look for these early stage disruptors, the Kaos formula, because that's what these companies really thrive on. So this is a 5-point checklist to filter out what I think really has a chance to produce big gains in short order from what really doesn't. So Kaos is an acronym. It evaluates a stock based on 5 criteria: change, hype, acceleration, ownership, and size. So change is really the foundation of chaos and disruption. These small companies burst onto the scene and change things in a big way, and they can be doing it under the radar for a good bit of time, actually, before Wall Street catches on. The hype part is basically looking for trends that are being hyped, right? Like artificial intelligence, 5G, and then finding companies that nobody's heard about yet that are going to enable or benefit from these trends, right? Acceleration is about the potential for exponential growth, really. 30% growth year over year is good, but 100% plus growth is how you really see big gains in short order. Ownership looks just like that. Looks at just that, right? It makes sense to go after companies whose founders, management, and board members own a lot of the stock, because they have the same interests as you do. You also want to follow great investors. You mentioned the biotech thing, and I do invest in biotech also. And, there you've got the Baker brothers, who have a long history of making big money in that tough space. So if you're looking at a biotech stock that checks all your boxes, and the Baker brothers have just invested in it too, that, helps reinforce your thesis. And then when it comes to size, I think it makes sense to go after, obviously, small companies that are going to shake things up in large markets, because that's the easiest way to grow fast in short order, right? It's a lot harder for a 100 billion market cap company to grow into a $1 trillion market cap company than it is for a $100 million market cap company to grow into a $1 billion market cap company. But then you can look at other things too, right? All these big tech companies, they still need things, right? There's a lot of components that go into an iPhone, for example. So you can look another thing I like to look at is picks and shovels investments. The term comes from California gold rush, as you might recall. Thousands of folks rushed out west to make a fortune. Few found gold, most just found dirt. But the entrepreneurs selling the mining equipment, the picks and shovels, got rich. And so today, a picks and shovels company is one that provides products or services that allow an industry or trend to thrive, or one of these big companies. Last time I was on, I talked about an RF filter manufacturer for 5G, which is going to go. These filters go in every single smartphone. So, and Cisco routers and switches, for example, were the picks and shovels of the internet, really. And so, you can really win big in those areas. and this kind of actually is good segue into this really cool company that I've been looking at. It's a picks and shovels play, I use the Kaos formula to get to it. And so basically, back in 2012, Google Glass was supposed to be the next big thing. I'm sure you remember these things. They were shaped like a pair of glasses without lenses, and they had a mini computer in the upper right corner and what would have been the right lens. And Glass is what we call an augmented reality headset, or an AR headset for short. AR headsets overlay digital information onto what you see in the real world. So I'm sure you've seen examples of this in the movies when a fighter pilot locks onto an enemy jet, or when Tony Stark's Iron Man helmet overlays information onto his field of view. Now, Google released Glass in February of 2013 to a lot of hype. You probably recall. It was featured in Time magazine, endorsed by celebrities, and touted as the future of smart devices. Business Insider even predicted that by 2018, Google Glass would sell 21 million units a year.
I love this forecast.
Yeah, but it was a total flop. I mean, I'm sure you remember people who wore Glass being derided as glassholes, right? So Google ended up pulling Glass from the consumer market in 2015. Now, it failed for a few reasons, of course. Its outward-facing camera creeped people out because you couldn't tell when someone was recording you. But more importantly, it didn't solve a real problem. Google couldn't even find truly compelling uses for it. But then a few years ago, Google noticed giant companies like Boeing starting to ask questions about Glass. So Google developed a lighter, more versatile AR headset for business or industrial purposes called Google Glass Enterprise Edition. And its little mini computer can be removed and attached to safety glasses, goggles, or the inside of a helmet. And it's also got a light that lets people know if you're taking photos or recording video. So it takes away the creepy factor. But the point is that lots of big companies are interested in this new Google Glass for a simple reason. It improves productivity, efficiency, and safety, right? So, for example, workers at a Boeing factory use Glass to assemble these complex wire harnesses, thousands and thousands of wires. It's really, really complicated stuff. They used to have to go through, an instruction manual on paper or a laptop or a tablet or whatever. But using Glass, they can call up the schematics and use voice controls to navigate the instructions. And Boeing says that this has really almost eliminated error rates and boosted productivity by 25%. And in jobs that require physical tasks, the advantages of using AR headsets are almost limitless, really. Imagine a repairman fixing a power line. An AR headset allows them to call up instructions without having to juggle a manual or papers. It allows him to answer and talk on his phone without fumbling around. Using his camera, he can share a live feed of what he sees with a colleague. Everything he needs is available in his field of view, so he can focus on the job at hand. And lots of companies are finally catching on to this. Technicians at ThyssenKrupp Elevator use AR headsets to while repairing elevators at One World Trade Center in New York, and they've cut repair times by more than 60%. Technicians at Airbus factory in France use these headsets to, position cabin seats and all the furnishings down to the millimeter, and they've eliminated errors and boosted productivity by 500%. So this is all, we're just at the beginning of this, what I think is going to be a really, really big trend going forward. AR headsets are going to improve productivity for millions of companies. They make workers better, faster, smarter, and it's really a technology that companies can't afford to ignore. And right now, we're at an inflection point for business or industrial AR. I've actually been watching the space for years. Until recently, companies were only committing to small pilot programs, but now they're really starting to scale up and make big production orders. For example, DHL Supply Chain started testing AR headsets in 2015, and then they recently announced that they're going to use them in 350 North American facilities as part of a $300 million tech upgrade. Market intelligence firm IDC expects exponential growth in AR spending going forward. It's expecting, I think, $120 billion in sales by 2022, which would be a 1,400% increase in just 4 years. And from the supplier side too, they see this growth also. One major supplier I talked to expects 1.3 million AR headsets to be shipped annually by 2022. That would be a 2,200% increase in just 4 years. So basically, all the evidence suggests we're finally on the brink of an explosion in industrial AR. Now, there are a lot of different headsets out there, right? Like, so Google's got one, obviously, RealWear, Aristic, Westunites, Vuzix, and Toshiba. They all sell their own headsets. But what's cool with this pick is it doesn't matter for investors which of these companies wins out, because all these headsets use technology from one company. The company's called Kopin. It's a $40 million market cap company that supplies the microdisplay technology for basically 80% of the business AR headsets on the market. So the microdisplay is the tiny computer screen I mentioned earlier. All AR headsets have one, and Kopin provides most of the microdisplays, which these microdisplays I equate to the picks and shovels to the business AR headset market. So I think there's a huge opportunity here to get positioned early in this business AR trend with a company that's going to ride the growth to the moon. The stock is crazy cheap right now, and it's probably at least a two-bagger over the next year, and potentially much, much bigger gains than that going forward, I think.
Yeah, and the symbol is as KOPN with Kopin, but I was actually looking at it as well. I know that they have a lot of cash, actually. I mean, it's a $42 million market cap company around, but they have like $25 million in cash. So it is, it is interesting. It is interesting. This is a company that could benefit tremendously. And I'm going to ask you to share, more ideas in a second, which I know my readers always love, my listeners always love. So, but I wanted to go back to something that you said earlier where you were talking about 5G, right? And saying, you look at 5G and then you look at companies, because a lot of people, I think when they look at disruptors, they look at individual companies, which is a bottom-up thesis. You look at that specific company no matter what, but you have an economic background, right? So do you look and say, hey, you know what? You just cited a whole bunch of numbers for augmented reality, which you're like, okay, who's going to benefit? It's almost like a top-down approach, which you really don't hear when people are investing in disruptors. It's usually more company-specific, where you may look at augmented reality, 5G, or even AI, and then work your way down. And I thought that was interesting. But does the economic background help with that? Because it sounds like you're looking at the industry, the numbers, and then you're actually looking at the stocks instead of finding maybe individual picks, or maybe you use both styles of investing.
Yeah. I do like to do both. The economic background helps with that, but also, economics is about human behavior, and it's really, I'm trying to find also, the numbers are crucially important, to back up your thesis and everything, but also what's really important is a story that investors will catch on to, because, if they'll catch on to it, that's the stock that they're going to buy, right? So, so that's where the economics helps as well. I mean, a lot of people talk about numbers and economics, but I was more of the Austrian economics school of thought, where it's micro based, and it's a lot about human action, really. And so you find these really cool stories, and then use your top down and bottom up approach. I think I don't like to pigeonhole myself in any particular way, and maybe I don't know if that's inefficient or not.
That's great.
Yeah.
No, that's great. Yeah, I mean, even for my research, it's anything and everything, right? It's like, it's never one style of investing, because if it was one style, the whole world would use it. And
right.
I agree with you. Yep.
Yeah.
So let's go into any more ideas that you should, because I last time we got some really good feedback, because you did provide some ideas, under the radar ideas, but anything else that you're looking for, maybe in a different industry or something that you see that's exciting. Yeah.
Frank. So another company I'm really high on right now is in the cancer immunotherapy space. For decades, doctors have basically relied on surgery, radiation, and chemotherapy to treat cancer. In other words, you're talking about cutting, burning, and poisoning patients, right? These treatments, whatever, kill cancer cells, but they kill healthy cells too. And, the side effects are often as bad as the cancer itself. Immunotherapy is completely different. The treatment itself doesn't attack the cancer. Instead, it directs the immune system to do it. So basically, it works like this, right? In healthy people, the immune system does a great job of fighting off infections. Every day, we're bombarded by bacteria, viruses, microorganisms that attack our bodies. But healthy immune systems usually kill these invaders before we get sick. cancer immunotherapy really just builds on this idea. It trains the patient's immune system to recognize cancer cells, then nature does the rest. So left alone, our immune systems will kill some cancer cells, but as the cancer grows and spreads, the immune system basically becomes less and less effective. There's this great doctor from MD Anderson Cancer Center, Padini Sharma, and she says that cancer cells evolve, get smarter, and basically learn to hide from the immune system. The cancer tricks the patient's body into ignoring it. So, and she says that with cancer immunotherapy, we can reset the immune response and get things going again. Now, it's important to know that you probably heard this term a bunch because there are several different types of cancer immunotherapy out there. But basically, they all try to boost or restore the immune system to fight the cancer. The most powerful approaches today appear to be T-cell therapies. T-cells are like the body's special ops soldiers. They hunt down, lock onto, and destroy specific targets. And with T-cell therapies, doctors basically remove the T-cells from the patient, teach them to spot cancer better, then put them back on the patient. The process it essentially reveals like a red target on cancer cells, making it easier for the immune system to do its job naturally. And this red target is called an antigen. It's like a signpost telling the immune system the cell doesn't belong to the body. The antigen is a specific protein, without getting too technical, it's a specific protein that's overexpressed on cancer cells. That means that it shows up on a lot of cancer cells, but rarely on healthy cells. So because of this, T-cell therapies can help the body kill cancer cells without killing healthy cells. It's obviously a really good thing. The science, of course, is really complex, but the idea is really simple, right? Instead of using a drug to kill cancer, doctors just supercharge your own immune system to do the job. Now, there's a ton of hype around these T-cell therapies today, and that's because they generate a lot of what are called complete responses in clinical trials. This means that patients basically show no sign of cancer after the treatment is over. But there are a lot of problems with T-cell therapies that are currently in development and on the market. The first problem is targeting. Today's T-cell therapies only target one antigen. So this is a really big problem because cancers are complex. They express lots of different antigens. And so any treatment that only targets one antigen will miss a lot of the cancer cells. And that means the cancer will probably come back and it won't be cured. Second problem is called durability, really. Durability refers to how long a cancer therapy works before the cancer starts to get worse again. So even though T-cell therapies generate a lot of complete responses, these complete responses don't necessarily last, and the cancer eventually returns. And so after T-cell therapy, there was a particular trial I read about. 90% of patients with a certain type of blood and bone marrow cancer had a complete response, but the cancer returned in most of these patients within 5 years. So that's not good, obviously. Only about 20% of the patients who were originally cancer-free after the T-cell therapy were still cancer-free 5 years later. And the third problem is side effects. T-cell therapies have a lot of severe side effects. The big one is called cytokine release syndrome. It can be fatal. It's killed several T-cell therapy patients in clinical trials already. Another one is damage to the brain, neurotoxicity, and other parts of the immune system, to the nervous system, can cause headaches, memory loss, seizures, life-threatening brain swelling. And then finally, there's the problem of cost. These things are really expensive. They're complex and expensive to make. It costs anywhere from $75,000 to $125,000 just to manufacture a single dose, and that translates into high prices for insurance companies and Medicare patients. The two T-cell therapies on the market today cost $373,000 and $475,000 for a one-time infusion. But there's this really cool company that's been operating in stealth mode under the radar at Baylor College of Medicine called Marker Therapeutics, and they've created a new type of T-cell therapy that potentially solves all of these problems. Marker's technology could completely change the game in cancer therapy, which is a $120 billion global market. So the clinical data has shown that this therapy can target up to 11 different antigens at once. So it's like having 11 different cancer treatments all in one. And it's potentially much more durable, safer, and only 1/10 the cost of all of other T-cell therapies. So it's easy to understand why I like this company so much. Still really early stage. I mean, of course, it's not going to generate revenue for years, but there are a lot of, like with biotech, there value inflection points along the way with the release of clinical trial data. So it's a $190 million market cap company with a multi-billion-dollar potential right now. So yeah, that's the second one. That's another one that I'm just really high on right now, and it's priced. It's really cheap right now.
No, I appreciate the research and digging in, because a lot of times when I have people on here, they give you the stock and maybe a paragraph or two, but just really going in, you could see how you do the homework. And the symbol for Marker Therapeutics is MRKR. And really great stuff. I mean, we covered a lot, but I wanted to get to this topic, which is probably the most important, is before your investing career, you played running back for the University of Texas, which I'm pretty sure they won the Cotton Bowl, right, that year?
Yeah.
So I was going to ask you, people say it's been a tough year for Texas, but, when you look at Texas, and I follow college football, that they only lost to LSU early on in September by a touchdown, right? And LSU just beat Alabama's great. They also lost to Oklahoma, maybe TCU is a little bit of bad beat. But what are your thoughts on that program? Because people are anxious to see if it's going to turn around. And, man, when it comes to football in Texas, I think everybody knows how important it is.
Yeah, I mean, it looked like at the end of last year, I remember what Ellinger, the quarterback, said, we're back. And it looked like they were going to be back to, back in the mix of, I guess, when I was playing, we ended up, I think, 14th or 15th in the country. Ricky Williams was the running back that year for us, and I was one of his backups. He was terrific. But thankfully, I'm from Louisiana also, so I've been following LSU. So when Texas is bad, I can just hang my hat on LSU. So, I think Texas is they're still in the top 25, I think, but just barely maybe. But it's a proud program, and they're going to do whatever it takes to get back into the mix sooner rather than later, I think.
Yeah, definitely. All right. So we'll end it there. And listen, I appreciate the ideas. And if someone wants to learn more about you, how can they do that, Chris?
Yeah. So I'm the Chief Investment Officer at RiskHedge, a disruption-focused research firm. And so it's just riskhedge.com, RiskHedge.com. So that would be just a great way to get acquainted with our stuff and read through the past issues of that letter. And then, if there's anything you want to move from there, there's all the information on the website to do that. So yeah, riskhedge.com. And
All right, that's perfect. And Chris, thanks so much for coming on. Again, I really get a lot of positive feedback, which I'm going to start sending to you, because people love the ideas. They love tech. They love getting into disruptive companies, which is definitely a forte. So I really appreciate you coming on, buddy.
Well, Frank, I appreciate you having me. It's always a pleasure, my man.
All right, thanks. Hey, guys, great stuff from Chris. Always love his ideas, his take on tech. As you can see, he does a ton of research on these names, right? A lot of times when I have people on here, they'll just go into, hey, I like this stock right now, and maybe give you, a reason, maybe a bullet or two. But I love the fact that he went through the reason why, even in immunotherapy, here's the 4 things when it comes to T-cell technology. And I'm very familiar with this industry, as you know. I've been talking about it for over 5 years, probably more like 6-7 years, really early to this trend. But he talks about the risks in T cells and how this is a company that addresses those risks. That's important, because for me, my question would have been like, listen, I've been investing in these things. A lot of them have made money. A lot of them have sold off. Why now? And, he did a good job explaining why now, why this company addresses that. Also, augmented reality is a trend that I've talked about probably 4 or 5 years. This is, merging virtual reality with the real world. And I've been going to Consumer Electronics Show every year for, I think it's 8 years now. And I'm going this year as well. And the last 4, I've seen huge developments in this technology where he's right. On the industrial side, people are using these. You could put the glasses on and someone could coach you from London, and you could be on a ship in the middle of nowhere on, one of these big, floating platforms, oil platforms. And, if anything goes wrong, they're able to walk you through it and show pictures. And, it's kind of amazing. I've sampled this technology, and I know about Google Glass and how they canceled that. But, that's an interesting play. This is a trend that's going to happen. It's just a matter of when. I thought it would happen a little bit earlier. I mean, virtual reality is out there, but this augmented reality is like putting regular glasses on. And, you could play pool and it'll show you the exact angle through these glasses where you could never miss a shot. That's how insane it is. It's incredible. I mean, you could put them on and you can get directions and just like you have your GPS system and most cars come equipped with that now. Now you have all that in your glasses. You could talk to someone and say, okay, I'm going to talk to this person, and it'll give you a whole thing, a whole platform, and look them up on Google, and you know everything about this person before you even talk to them. This is pretty cool technology, but it is a little far out. And now that you're seeing Google get back into this all in and a lot of other companies, hey, it's a good trend, but I like that he covered all this stuff. It's really cool. So yeah, I thought it was cool. I always say this podcast is about you, not about me. So let me know what you thought, that interview, at frank@CurzioResearch.com. That's frank@CurzioResearch.com. Now, let's get to my educational segment. I wanted to dig into sentiment again, but from a different angle. Because this is something that helps you become a better contrarian investor. Because I covered sentiment, and this was in my educational segment, last week's podcast. This is different. Because when it comes to being a contrarian investor, most people are not. They think they are, but they're not. I'm not putting anyone down. It's just, it's a fact. Because you think you're on an island all by yourself, which is a term I use a lot. And in the end, you're really not. It's like calling for a market crash. You calling for a market crash? Well, I mean, maybe now because a lot of people are bullish when, technical indicators are higher and we're at highs. But everybody's calling for a crash. I mean, you could just look it up, everybody, the typical people. They're all crashed. The market's going to crash. It's overvalued. We have too much debt. These companies are buying back stocks. The only way is keeping earnings up. I can keep going and going. Trade war fears, no international growth, emerging markets. I keep going and going here. Okay. But if you're calling for a crash, you're not a contrarian. I hear that from tons of people. If you're buying uranium, you're not a contrarian. It's out of favor, yeah, based on price, but I know hundreds of analysts, executives, money managers that are super bullish on uranium and have been for the last 3, 4, 5 years. It's not a contrarian play. It really isn't. Yes, it's the price depressed, but if you talk to people, especially with the conferences that I go to, they're all bullish on uranium. You want to be a contrarian? You go up on stage and say, short uranium. That's a contrarian. Nobody's shorting uranium at this level. Where is it? $23, $24 uranium prices? Put that in perspective, what they? 130 pre-Fukushima? You want to be a contrarian? Buy department store retailers right now. That's a contrarian, right? Into the holiday season where these guys are going to try to compete with Amazon, one-day shipping. These guys their margins are already terrible. You really think they're going to do good through the holiday season? Or be a contrarian? Short gold. That's a contrarian play. Does anybody tell you to short gold? No. Everybody's bullish on gold. You think buying gold is being a contrarian investor. Maybe, you don't believe in the market and you don't want to see the stocks go higher and you think that's going to influence gold or whatever, inflation, whatever you're looking for. But short gold here, that's contrarian. Who's telling you to short gold? I don't know anyone saying short gold. I know hundreds and hundreds of analysts that are telling you to buy gold here. They say it's going to 5,000, 10,000. I heard the same story for pretty much the past 7 years. They've been dead wrong. Gold's going higher. It's going higher. You got to buy it. Yes, they're destroying the currencies. And it's everything. It's just funny when you listen to them. Again, when it comes to debt and all this nonsense, it's not real interest rates that drive gold. It's the stock market, guys. It's a stock market. If stocks are going higher, gold's going lower. It's that simple. It's that simple. Trust me. I've done all the research. I've looked at deflationary trends, inflationary trends, negative real interest rates. Does that drive gold? No. We had negative real interest rates for how long? And 2014, 15, 16, where did gold go? It was depressed. It's a hedge against what? I mean, you let me know. We're inflating these currencies. I mean, constantly print money. That's not the driver of gold. It's just not. I mean, it's a stock market. People fear this. That's why when you look at the trade talks, when they go negative, gold surges. When they go positive, gold crashes. It has nothing to do with inflation. It has nothing to do with deflation. It has nothing to do with real negative interest rates. But I just love because I've just heard people have been in this industry for 30 years tell me these stories, and they're not looking at the right data. They're just not. But it's not easy being a contrarian. It's not easy going and saying, I want to short gold. Good luck. Or short uranium. But the best way to be a contrarian investor or find contrarian investments is by looking at the short interest in stocks, which is available for free. Just do a Google search, come up with different sites. But the most heavily shorted stocks are the ones the smart money is betting against. The institutions, people who can go short. And these companies are usually depressed. They have tons of negative press you'll find in them, which was probably released by the firm shorting the stock, which is perfectly legal. You could say, hey, I'm going to tell you tomorrow what stock's going to go to zero. And you could load up as much as you want, and you could tell everyone that stock and sell it 5 minutes after that report goes out and generate 20% returns and get out of it. As long as you don't disclose everything in that disclaimer, you're fine. That's the market we live in. Can't do anything about it. That's legal for some reason. I don't know why. You could find a lot of these stocks. You find them on different lists. Want to know some of them? Netflix, right? All competitors, Disney Plus, their lunch eaten by everybody. GameStop, Bed Bath & Beyond. McDermott has been a real dog. U.S. Steel as well. Rite Aid, Papa John's with the founder and all that stuff. Range Resources. You could put a lot of energy names on that list. Tanger Factory Outlet. Alibaba, even though they were the biggest beneficiary of all that spending on Singles Day. One of the most heavily shorted stocks. Uber. Makes sense. Just a lockup period. Everyone's looking to sell that stock. Wayfair, Domino's. Buying these companies, those are contrarian plays. That's a contrarian investment. Now, I don't want you to buy these companies blindly because I just named them. I'm not talking about that. But what you want to do is find out why the smart money hates these names. And it's real easy to find. Again, using Google, just type in, why Tanger Outlets is going to crash. You're going to find a ton of short reports on it, short thesis, articles from wherever, if it's Forbes, whatever. So many different sites. Yahoo Finance will be on, and maybe even the Wall Street Journal will write about it. You can put that, just change Tanger with any other stock, GameStop, Bed Bath & Beyond. And then break it down. So the reasons that these investors are short, do they still exist? Like IBM. When it was 200, everyone was talking about revenue decline, 180 revenue decline, 160 revenue declines, quarter after quarter after quarter. They talk about competition, slow-growing businesses that was still, a big overall portion of their revenue. I get it. At 161, I got it. But the stock fell to 116. And you know what? IBM was aware of every one of these risks. Every one of them. So what do? They start investing heavily over the past 6-7 years, which is finally coming to fruition now, in hybrid cloud, where they took over Red Hat, game-changing acquisition, big data analytics, AI. I mean, this is a company where, hey, it's not this old legacy server farms, all this crap anymore, which are very, very expensive and low-margin businesses. So while revenue is declining, profits are surging, because they're getting into higher margin businesses and more services. So for me, looking at that, we're able to buy at 116. It's now 135. And I can tell you, IBM is still a hated name. Owning IBM is still a contrarian play. But you want to look at the balance sheets of some of these names, especially when they have small caps. Some of these companies will have a lot of cash on their balance sheet. They may not really be leveraged. Some of them are. You have to be careful and look at their debt schedule payments and things like that. But they'll have a lot of cash on their balance sheet to where the stock price has fallen pretty close to their net cash. You see this a lot in biotech. I've talked about this a lot of times. If the FDA rejects a certain drug in phase 1, phase 2, phase 3, goodbye. That stock's gone. 40, 50% in one day. But the stock will fall near cash, and you could buy that, and you're getting the rest of the pipeline of drugs for free. And if you analyze the data, it's the FDA where they're not saying, hey, this was terrible and get rid of this drug. It's horrible, but they may say, hey, you know what? We didn't like the safety. We want to see a little bit more of a better safety profile, efficacy. We want to see, extend that life, whatever it is. That could result in higher doses, so they go back, and retest it. And if everything works out, like with the case with Biogen, you'll see this stock, which, in March, it fell 20%, 25%. And then it recuperated a lot of those gains because they came back with positive results for that Alzheimer's drug. But your job as analysts is to figure out if these risks will subside in months or the years ahead. Because if they do, these names are going to surge. They'll pop 30% in one day on strong earnings or any sign that business is turning around. And it's not just a small cap thing. I mean, you look at all large caps; they've all had major problems. McDonald's had huge problems, and then they addressed them, announced all day breakfast. They came back. Nike as well was terrible for a while. Chipotle is the best example. Food poison, E. coli. They figured it out. The stock fell from $750 in 2015 to $280 in late 2017. That's how much that company got crushed. And the shorts were all over it. Nobody was buying it. The contrarian player would say, hey, you know what? Now's the time. Even at $350 if you bought it. Why? Because today it's over $750 again. You're looking at 170% returns in less than 2 years on a large cap, well-known name brand. Because they figured it out. Now, getting back to the contrarian thing. How many people told you to short Tesla over the past 2 years? Think about that for a minute. You go on Twitter, forget it. I mean, if a Tesla bumps into another car, it's like the biggest thing in the world. There's self-driving didn't work, and you can't get parts anyplace, and the China gigafactory is not on schedule. All this, and I get it. You look at the tax credit; it was going to disappear, which is huge because you have all this competition coming in. I get it. But when everyone's leaning to one side, and Tesla's a good example of this, and to be fair, even I've been negative on Tesla. But when you look at it and they come out with this quarter where Elon Musk does a great job of knowing what everybody hates because everybody lets him know every single day of his life through Twitter. And he's able to address that. Listen, we need costs to come down. We need production numbers to go higher. We need to establish where we don't need cash over the next 2 to 3 years. And last quarter, they pretty much addressed a lot of those issues, and the stock soared. It's trading 10% off its 52-week high, Tesla. You would never know that. How many people have told you? I've read, hundreds of people on Twitter bashing it, and I get it. But it's a sentiment thing when everyone's on one side. How many people do you know were saying to buy Tesla? Very, very few. And if you did, you were like an outcast. This guy's an idiot. He doesn't know anything. What is he talking about? Yet, that idiot made a lot of money because it was a contrarian play. How many people told you that Intel was a piece of garbage? They didn't tell you. They certainly told me because we recommended it. We're doing very well. I think we recommended mid-40s. Actually, I've been telling you to buy this thing since 30s. Great company, low multiple. Now people are starting to like it because it's near a 20-year high. What about Tiffany, one of the most heavily shorted stocks this year? Just got a takeover bid from Louis Vuitton for $14.5 billion. That deal's probably going to go down closer to $16 billion to get that done. It's already trading above that level. But Tiffany's trading close to its all-time high. All-time high. We're talking about a stock that went public in 1987. One of the most heavily shorted stocks. Not all of them work. We've seen McDermott and GameStop get destroyed. But start looking at these names. These are contrarian plays that you should feel like. These are stocks that are completely hated, right? They're heavily shorted. Negative stories, tons have been written about them. You could buy these names at dirt cheap prices because of all the negativity. And buying Tesla 6 months ago, people thought you're nuts. Again, even Netflix, right? Even Netflix. But that's what a contrarian investor feels like. You should be nervous. You should feel nervous that you're making or potentially making one of the biggest mistakes in your investment career. That's when you know you're a contrarian. We're like, whoa, man, am I going to get this thing wrong? What's going on? I really felt that way about Mattel, which is doing great. Recommend Mattel. People are like, you're crazy. They have the lawsuits against it. Oh, it's factored in. The stock's down tremendously. And if you look at all their businesses, everything, Barbie, Hot Wheels, you look at everything has turned around. International has turned around. Everything has turned around. Now they settled this thing, popped 20% in one day after earnings. But that's how you find the best investments. Because when you're a contrarian and you're buying these names, and again, it's going to feel like you're on an island all by yourself. I know I say that term a lot. But when you're buying a contrarian investment, it's a hated company. What does that mean? It means a lot of the risk is already factored in. It means that if a company reports inline earnings and inline guidance, that thing's probably going to go up 20% because that's extremely positive for a company where sentiment has been overly negative. Opposed to buying Apple here, where everyone's super positive. Disney here, super positive. I think you're crazy for buying Disney here. Every analyst, it's just positive. This is great. They're not generating money on this thing forever. This is an act of desperation by Disney to get into this business. There's nobody that makes money off of streaming. Nobody has. I mean, Disney used to sit back and collect royalty fees, and it was that's the greatest business in the world. Sit back, get a check, go out, go on a golf course. Awesome. Now, I mean, they were receiving these checks from Hulu. Now they own Hulu, or most of it. And you know what? Now, instead of getting those checks and having fun on the golf course and high-fiving all your friends, now you're losing $1.5 billion a year. Crazy business. Just surprised so many people like it, especially when you look at Disney's debt structure, which I covered in detail on Frankly Speaking, which is my podcast only available to subscribers. It's really, really cool. But that's how you be a contrarian investor. Again, told you that segment wouldn't be boring. A lot of people talk about contrarian, but you should literally feel like you're on an island by yourself. Because if people share the same sentiment as you with an investment where you're long gold and the market's going to crash, there's a lot of people out there that believe that. That's not a contrarian play. It really isn't. Hopefully that came across in that segment, and hopefully I taught you a little bit. And again, a lot of these lessons come from the mistakes that I made. It's not like I'm some kind of genius. I've just been doing this for a long time, and I want to share those stories with you. This way you don't make the same mistakes and become better investors and make more money. This way you can take your families out, take your kids out, take your wife out, whatever you want to do with your money, buy houses, buy cars, whatever it is. But that's the goal here, to increase our generational wealth. So guys, thanks so much for listening. Quick note. We all launched at Rich Suttmeier's newsletter. It's called the 2-Second Trader. It's going to happen probably in about 2 weeks. Super excited. His system is going to be on our site. So it's not just Rich coming out with a trade every week based on his proprietary system, which has been awesome. If you don't think it's awesome, go to CurzioResearch.com absolutely for free and look at Chart of the Week and just look at his past calls, which he writes every single week. Seriously, just go and look at you'll look at 5 or 6. He's been dead right on almost every single one of these things. He's been red hot. So this is his system that not only are you going to get a trade every single week, but it's going to be a ticker box on our site where you can put any stock in your portfolio, and it's going to give you the trading levels of whether it's buy, or sell, or whether you should hold. So that's original. I think that's really cool. It's going to be a great feature. We're going to offer a great price for our listeners and subscribers, but it's our first product that we launched in 18 months. I'm really, really excited about, and I know Rich is excited too to bring it to you. So a lot going on behind the scenes. I just want to mention that to you. If you're on our list or you listen to this podcast, you're going to hear a lot more about it. And please sign up through me through this podcast or through the offer that you're going to receive, because that's going to be the cheapest price that you're going to get. And that's going to happen within probably the 2 weeks that we launch this thing. After that, we're going to raise the price significantly. But I always want to offer discounts to my listeners and people who've been following us for a long time. And, I always appreciate that. So guys, covered a lot today. That's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.